Introduction to term insurance. We are going to go through some things about term insurance. As always, if you're looking for more information, please do refer to your study notes. The life insurance module sections 2.1, 2.2, 2.7, and 2.8. Now, there are three things to help you differentiate between term and permanent life insurance, and those are that term insurance is temporary, it is renewable and convertible, and it's easy to understand and customize. We're going to go through some definitions that actually apply to both term and permanent policies. So it is important to remember these so that when you're explaining this to a client, you do understand what you're talking about. So the first is insurer. That's the insurance company that issues the policy and eventually pays the death benefit. Now, this is probably the company that you are representing to your client. The policyholder is the owner of the policy, and that can also be the life insured. So the person whose life is insured in the policy, that is the person who needs to pass away for the death benefit to be paid out to the beneficiary, and the beneficiary is that person who receives the death benefit. Now, it is possible for the policyholder and the life insured to be the same person or different people. For example, in a parent-child situation, the parent will be the policyholder, the child is likely to be the life insured. Or if it's a situation that there's only one person, you are the policyholder and it's your life that you're insuring. Now, there are two different types of term insurance, a single life and a joint life. Single life, there's one life insured, so only one person needs to pass away in order for the death benefit to pay out for a single life, and it's only based on one life. Now, the same thing is true of joint life. Only one person passes away. However, it does insure two lives. So there's either a first to die or a last to die option. And as I mentioned, two lives are insured, but the death benefit only pays out once. Now, the reason that a lot of people sign up for this one or go with this option is because it is a cheaper policy and they only need the death benefit to pay out once, whether it's a mortgage situation, business, spousal support, or even estate planning. They only need a payout either on first or last death, and so that's why they would go with a joint life. Now, this is different than a combination insurance policy. That is not the same thing. That one only saves money on administrative fees. A joint life policy saves more than that because it only pays out once. And what is term insurance? So term insurance is for a specific need, like a mortgage, a debt, child or spousal support. And this illustration that I'm putting up for you right now, that I'm just drawing out, this will help you understand. So a term policy, it starts on day one and it continues for the length of the term that your client has signed up for. So in this case, 20 years, and it continues every 20 years until the end age. So the age that the policy expires. And that usually is based on the life insurance company or the insurer. And it is very clear in their policy when that end age is. Now, it typically tends to be between age 65 and 100, just based on the life insurance company. Now, every 20 years, this policy will increase in price, and that increase usually tends to be quite significant over the length of the policy. These increases are always very clearly listed in the contract given to your client, so they are aware that there is an increase. In some situations, they might even know exactly what that increase is. Sometimes there is a range for the increase. Now, terms range between 1 to 30 years. You can have a term that's 1 year, or you could have a term that is 30 years, 5 years, 10 years. I think you guys get the point. And they can only be issued before a certain age. So, and that age usually tends to be between 75 and 80. After that point, you can no longer get a term policy. Now, the longer that the term is, the more expensive the premium is. So if you were to go for a 20-year term versus a 1-year term, the 20-year term is going to be more expensive. And that is because the insurer is taking on more risk in that situation. There is a higher chance that the life insured will pass away within 20 years as opposed to within 1 year. And so they do increase the premiums based on that. And disadvantages and advantages of term insurance. So term is extremely low cost in the early years. It's very easy to afford, and it's also easy to understand. The premiums are set during a term. So for example, with that 20-year term, you saw during that 20 years, you pay the same amount every single month. It does not change. It does not alter. Then on renewal, you pay that new amount if you choose to keep the policy. Same amount, doesn't change, doesn't alter. Now, term policies are renewable and convertible. A lot of the time, they automatically renew, so you don't lose your policy. And convertible means that they can be converted into a permanent policy, often without a medical or health questions. They're also customizable. You saw that a little bit of that you can pick the term that you want. You can also pick the death benefit you want. So there are some customizable options within a term policy. It's important to remember that a term policy is not an asset. So there is no cash value in a term policy. It does not increase, the value of it does not increase no matter how much money you put into it. It is always the same death benefit. You cannot use it as an asset like you would your house. The term does end or expire, so there is an end date for term policies, and the cost of the premium does increase at each renewal. So you sort of saw that in the illustration on the previous slide. So every time you hit a renewal, the amount of money required, or the premium, increases, and often it will increase quite significantly. So if you keep the policy until it expires, you are paying quite a bit of money for that policy. So you're kind of making up for the fact that you don't pay a lot in the beginning. So that's something to really make sure that your clients are aware of, that there is an increase coming at the end of that term, and that it will possibly be a significant increase, that they may want to revisit their policy before that increase comes. And that's all we're going to go through for term policies. As always, you can check out the details in our study notes. Again, that's section 2.1, 2.2, 2.7, and 2.8.